Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, we know Fed rate cuts are coming in September, now just 3 weeks away. But how much does the Fed usually cut interest rates? How will it affect your money, and what are the stocks that could win? I'm going to show you the data on 5 previous rounds of Fed cuts to explain what the Fed will do and how it answers your investing questions, along with important updates to shares of CrowdStrike and Nvidia. First though, the market is up more than 8% from the sell-off earlier this month, but that volatility and the uncertainty can return in a heartbeat. So if you didn't catch last week's video, check it out next. The 7 stocks that actually do better when stock market uncertainty increases. I'm going to link to that one along with a few others you might like in the video description below. But now let's talk about those rate cuts, because after the fastest hike in interest rates in 40 years, the Fed is now ready to start cutting rates, and it's all the market can talk about. The CME Fedwatch Tool, a market expectation of the Fed's likely path based on futures pricing, shows a market forecast of 73% that the Fed will lower rates by 0.25% when it meets here on September 18th, and a 26% possibility that it goes further with a 0.5% rate cut. Now, these market odds change with new data on inflation and the economy. Just last month, before data showed the job market weaker than expected, odds of a 0.25-point rate cut were at 92%, while a 0.5 point was only 3.8%, and some investors were still thinking the Fed would actually hold rates steady. Looking further out at the 8 Fed meetings over the next year, futures pricing shows the market expects the central bank to cut 7 more times, a total of 2% off from where the Fed funds rate is right now. If it happens, it would lower interest rates for consumers and corporations and could spike rate-sensitive parts of the market. But will it happen as the market expects? What has the Fed done in the past? First, understand that the Federal Reserve raises and lowers its Fed funds rate to guide its dual mandate. One, keep inflation low, while at the same time keeping the economy growing. To a point, these are conflicting because if the economy grows too fast, then inflation can take off, so the Fed raises rates when it sees prices rising quickly. That's what happened in March 2022 when the Fed started raising its rate from near zero after the pandemic. Increasing interest rates too high or hold them there for too long though, and higher borrowing costs choke off the economy, what we're seeing now after those 2 years. And if we put that Fed interest rate on a graph with recessions back to 1970, the effect of the Fed on the economy is clear. The central bank has continuously raised rates too far, held them there for too long, and sent the economy into a recession, only to have to cut rates quickly to jumpstart activity. And what's frightening here is the speed at which they raised rates over the last 2 years, hiking interest rates at the fastest pace in over 4 decades. But that does not necessarily mean the Fed will be quick about lowering rates, or nearly as quick as the market would like to see. We've already seen worrying signs of a recession, from its slowing jobs market to consumer and business credit defaults rising. The Fed's speed at which it lowers rates to support the economy could mean the difference between that so-called soft landing and a recession, and a big difference in stock returns. Looking at the Fed rate cut cycles back to 1965 and the stock market returns, we see 2 very different scenarios. When the Fed was able to jumpstart the economy quickly, avoiding that recession, stocks jumped an average 16% over the year from the first cut. When the central bankers are too late though, and the US falls into a recession, stocks fall by just over 2% on average. So with the market expecting 7 to 8 rate cuts over the next year, and the speed of which very much affecting the economy, I wanted to dig into previous rate cut cycles to see if expectations are realistic right here. The Fed has cut rates 5 times since 2002, but for very different reasons and at different speeds. The Fed cut rates by 1.5% in 2 meetings during the 2020 pandemic, emergency cuts and large ones, but this isn't really telling us anything because it was so specific to the pandemic. Interest rates were cut just 3 times in 2019 as the economy slowed from those 9 rate hikes in 2015 after the Great Recession, which raised rates by 2%. This time around in 2022, the Fed raised rates by a lot more, 5% over the last 2 years, so I think we can assume that they'll cut more than 3 times. More relevant may have been the 2007-2008 cuts after the Fed raised rates by more than 4% in the 2 years to 2006 to slow down that housing market. They certainly slowed down the market, popping the bubble. Rates were cut 7 times, and some unusually large cuts here in 2007 and early 2008, lowering rates by 2.75%, but it still wasn't enough. That meant the Fed had to cut an additional 3 times, emergency cuts of 1.25% later in 2008 to almost 0. Rates were increased 6 times for 1.5% starting in 1999 to slow the economy and deflate the stock market, which of course it did big time. The Fed then had to cut 11 times in 2001, lowering rates by 4.25%, and then another 3 times in 2002 for 0.75% in cuts just to prop up the struggling economy. So the 7 or 8 rate cuts the market is now expecting aren't out of the question, though maybe a little much, but I think the 2007 cut cycle is the most relevant and telling here. After increasing rates by 4% starting in 2004, close to the 5% the Fed has just raised rates over these last 2 years, the Fed only initially cut by 2.75% off of its rate, and that was an economy that was in much deeper contraction already. It's this conservatism, then, that leads me to believe the Fed will start by going slow, only giving us maybe a quarter-point rate cuts in the 3 meetings this year, and then sporadically next year. A total cut of 2% over the next year is still possible, but it would require data to start showing that the economy is in recession, and I'm not sure we're there yet. Whether the Fed can avoid a recession or not, stocks do typically rise as interest rates are coming down. The rate cut cycles back to 1965 show that averaged between recessions and soft landings, stocks made about a 5% return a year after the first cut. But there are parts of the market that could do even better. I'll get to the stocks most affected, but most directly, Fed cuts will affect your money by lowering interest rates on everything from mortgages to credit cards and car loans. The ultimate number of rate cuts and speed is uncertain, but we do know that rates will be significantly lower within a year. That means unless you just have to buy that new Lambo now, waiting 6 months to a year could save you a lot of money on your loan. There are 3 stock sectors directly affected by lower interest rates that should do well over the next year. Looking at a chart of returns over the last 2 years on those rising rates, real estate stocks and utilities have just barely broken even, while financials, specifically regional banks, have lost nearly 12%. All while the broader S&P 500 market index has jumped 39% over that period. Of course, real estate is always highly leveraged. A cut to interest rates is going to bring down financing, but also boost cash flows and valuations. Regional banks have been hit on competition for deposits as rates increase for money market funds, while also seeing the value of their bond portfolios cut as those bond prices fall, all of which could be slowly reversed on lower rates. And shares of utility companies do well as rates fall because those dividend yields start looking more attractive to investors versus rates on bonds, but also as that safety against a potential recession. Specific stocks I'm watching include Arbor Realty Trust, ticker ABR, the most heavily shorted real estate stock with almost half, 49% of the shares available borrowed and sold short. ABR is a mortgage REIT. It borrows on those short-term rates and then uses that money to buy mortgage loans as an investment, mostly multifamily apartment mortgages. Well, multifamily investors took out floating rate loans when mortgage rates were around 4%, but as those loans start to reset and the rates are closer to 8%, short sellers are betting the default rates increase and the ABR has to write down the value of those loans. According to Green Street, multifamily apartment values are down 26% over the last 2 years, and shares of another MREIT, Blackstone Mortgage Trust, have plunged 23% just this year. So those lower interest rates could be the lifeline that Arbor and the multifamily mortgage market needs, putting more of those loans back in the black and propping up values. That could start a run on short sellers to buy back the stock to cover their positions, and possibly a short squeeze that sends the price higher. There are plenty of individual regional banks like NYCB that will benefit, but an easier play is the SPDR S&P Regional Bank ETF, ticker KRE, which holds shares of 141 U.S. banks. Shares are already up 16% over the last months as rate cuts get priced in, but this one has further to run as financial health returns to the industry. A little more indirectly, growth stocks could also benefit, including solar stocks like Enphase Energy, ticker ENPH. Growth stocks benefit from those lower interest rates through discounted cash flow valuations. Basically, those higher future cash flows that make up most of the company's value are discounted at a lower rate and worth more now. Enphase also benefits as consumer borrowing rates come down and make it easier for consumers to take out the loans on their home energy solutions. More broadly there, solar stocks have had a very tough year, with the Invesco Solar ETF, ticker TAN, crashing 25% on just a flood of Chinese suppliers into the market, along with higher borrowing rates. It's already pushed supplier SunPower into bankruptcy, so most important when you're looking at these is survivability. Enphase has seen sales plunge 39% this year, but is expected to rebound with 44% revenue growth next year, and importantly, is still net income positive. The company has also been able to maintain cash flow positive and has $250 million in balance sheet cash to wait out the storm. Looking at the stocks I'm watching this week, CrowdStrike Holdings, ticker CRWD, will give its investors its first quarterly report on Wednesday following the July outage, with shares rebounding 24% from their low, but still down 30% from the peak. The outage was significantly larger than others we've seen in the past, and there is sure to be some client retention loss, but cyber firms just have a history of these big problems. The long-term growth in demand has always helped them rebound, and I still like the long-term picture for CrowdStrike. Management is likely to lower its sales outlook from the current $3.96 billion and 29% full-year growth, but the sell-off has lowered valuation to 16 times revenue, which is much closer to peers like Zscaler and Palo Alto Networks at 15 times revenue. More than $30 billion has been wiped from the company's market cap, which on a 20x valuation would imply about $665 million in lost revenue due to the outage. I think that's an overstatement and picked up shares near the sell-off low. NVIDIA, ticker NVDA, is going to be the big report on Wednesday, with its shares rebounding 23% from the July sell-off. Investors will be listening for an update to a rumored delay in the company's Blackwell chip, potentially a 3-month delay on performance challenges that forced a respin. It won't affect the prior quarter, which could see NVIDIA beat earnings and sales estimates, but the big question is going to be the rest of the year. Earnings are expected to have doubled last quarter, with full-year revenue up 95%, pushing earnings to $2.45 a share. Salesforce, ticker CRM, also reports Wednesday, with the shares still down 8% from the May slide following last quarter's disappointing outlook. Management noted some customer exhaustion on spending and said it could take several quarters to recharge its growth. That might already be priced into the shares, though, with expectations for a drop of 2.7% in revenue this year before 9% growth next year. Now, I am holding shares of Salesforce as part of my forever stock portfolio, but I'm not adding more just yet. I'll be waiting to hear what management says in its Wednesday report, or just for one more quarter before again accumulating the shares. Giving you the big picture here with the SectorSpiders.com sector tracker. 10 of the 11 stock sectors did finish higher last week, with energy the lone laggard on a 2.3% drop in the price of oil. Now, while a ceasefire agreement in Israel is a long shot, record oil production in the U.S. and softening demand for crude should continue to weigh on the price. We do have reports of Israel firing on Lebanon over the weekend, so that should boost the price into this week. Over the longer term, though, the price of oil is likely to come under weakness for just that economic worry and stress on demand. Oil stocks are still strongly cash flow net positive here, though, even in the 60s per barrel, but investor sentiment is going to take a hit and hurt those stocks probably over the next few months. With the drop, though, we are seeing good valuations for long-term investments, and dividends will definitely hold up. A bigger trend we're seeing here, real estate stocks jumped 3.6% last week and are now the second best sector after utilities over the last 6 months, with a 12% return versus 10.7% for the broader market. Property stocks took such a hit in 2022 that it is still the worst performing sector over the last 5-year period and still has a lot of value in the group. Now, I was early to this one, recommending real estate at the beginning of this year on hopes that the Fed cuts would start earlier. It didn't happen as soon as we would have liked, but now that Fed rate cuts are here, REITs are set to have a very good 2025. Make sure you know how to analyze these and find those real estate stocks, as I laid out in last week's video highlighting the 10 highest paying dividends, so look for that link in the description. It's set to be another slow week for economic news and earnings, with only the personal consumption's expenditures, the PCE report on inflation, of any note. The release is due out on Friday. It isn't expected to turn any heads though, with forecasts for the PCE inflation to come to just 2.5% from last year. It'd be the same pace as reported last month. Earnings are also largely out of the picture here, with 93% of the companies in the S&P 500 having already reported. Profit growth was very strong at 10.9% from last year, the strongest since the fourth quarter of 2021, on 5.2% revenue growth. That puts the price to earnings for the market at 26 times, the highest since October 2021, and well above the 10-year average, just under 22 times PE. Now, while I think the market is generally overbought and expensive right here, investor sentiment is strong, and hopes for those coming rate cuts should be supportive at least until those cuts start coming in this month. There could be some profit taking after the September 18th meeting of the Fed, especially if the market is disappointed with a 0.25% rate cut, but data shows that stock prices have gained 5% on average in the year after rate cuts start. Click on the video to the right for the 7 stocks that actually do better when market volatility increases. These are some great ideas to protect your hard-earned money with some counter-market stocks, so make sure you check that out. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.